The last strategy we're going to talk about one is kind of the deep end of the pool. But for those of you that have a good foundational understanding of option strategies, this one should not scare you. It sounds complicated, and it is, sort of is complicated to some degree. It's called a straddle strangle swap. Basically, what you're doing is you're basically trading a straddle and a strangle for at multiple time frames. You can also think of it as a double diagonal, or you can think about it as a put diagonal and a call diagonal at once. There's multiple ways to slice and dice it, but it's called a straddle swap, which is a mouthful. It's really a fairly neutral vol strategy. It's an advanced strategy that's basically trading volatility arbitrage between the very short dated options and the longer dated options. You're basically selling something with high vol and buying something with low vol, and basically being fairly delta neutral so that you don't have much exposure to the movements of the underlying security. You're basically shorting high vol and buying long vol, and kind of capturing the difference between the two. Again, like I said, sounds complicated, but let me help you break it down. What you're doing here is you're buying a 30 days to expiration. So you're buying a 20 delta strangle. So you're buying an out of the money strangle that's 30 days out. That kind of gives you, some directional exposure, or it's fairly delta neutral because you're buying 20 deltas. And then what you're doing is you're selling an at the money straddle. And the strategy driver here is actually selling that at the money straddle. Selling an at the money straddle is the purest way to collect income on an index option, 0 days to expiration. That's really taking advantage of that acceleration in time decay that I was talking about in that first slide, right? By selling a 0 days to expiration at the money straddle, you are collecting as much income as possible. And I'm going to show you how much income that you're collecting. But when you're selling an at the money straddle, that has unlimited risk, right? Granted, how much can an index move in a single day? There's a limit as to, generally speaking, how much an index can move in a given day. But you still technically have unlimited risk. It takes a fair amount of capital if you were to sell that at the money straddle naked, but it is overall one of the most profitable strategies of just selling a naked at the money 0 days to expiration straddle in the long run. But because most traders don't want to take on the unlimited risk, most traders don't want to have to put up the capital to trade a naked at the money straddle. So what you do is you basically buy this 30-day at the 20 delta strangle, because that's going to provide kind of that offset in terms of margin requirements, and offsets the delta risk as well. And because it's 30 days and it's 20 deltas, the cost to it is very close to the premium that you collect on that at the money straddle. And this is, like I said, the strategy driver is the at the money straddle. And what you're trying to do is potentially sell multiple straddles throughout the day. You sell the straddle starting at 9:30 in the morning. And what you're trying to do is, as soon as you collect 25% of the max gain of that straddle, you take profits on it. And what you do is you try to do it again. Meaning if the markets have drifted, a dollar higher, you basically recenter your at the money straddle and sell another at the money straddle. And you keep holding it either to expiration, or you do it where you collect 25% of the max profits and you take profits. If it turns to a loss, you just hold it through expiration. You don't have to manage losers, you only have to manage winners. And the key here is that you must close out both the short straddle and the long strangle at the end of every single day. And what you do is basically every single day you roll forward your straddle swap. Like I said, this is a advanced strategy, but for those of you that have a foundational knowledge of option strategies, this is kind of the deep end of the pool, but this is one of the more profitable strategies of selling 0 days to expiration. But let me just walk you through a real example, because that's going to help you better understand this. So I have this straddle swap set up. So what we're doing is we're selling an at the money straddle. So for example, for tomorrow, because we're trading at 522.20, let's actually move this down to the 522s just for arguments, just to be clear here. And as you can see, by selling the 522 straddle, here I'm collecting $1.57 on the calls and then 92 cents on the put. So I'm collecting roughly $2.50 in a single day by selling the at the money straddle. But like I said, when I sell the at the money straddle, I have unlimited risk, and it requires a lot of capital in order to trade this. So what I'm going to do is I'm going to buy basically the 30-day out of the money strangle, and that's going to cost me in this particular case about $3.60, $3.70 or so. So not much more premium than I'm collecting. And remember, that's 30 days out, right? And what it does is it basically reduces the amount of capital that's required to put up this trade. I only need about $2,000 in margin to trade this particular strategy. And the goal here is to try to collect that roughly $2.50. So think about it. If I can end up collecting $2.50 on that day while posting only $2,000 in margin, that's over 10% yield in a single day, right? You might not do that every single day, but what you're trying to do is basically, if let's say you sell this 522 straddle, and by 11 a.m., you've already collected 25% of the $2.50. What you do is you basically take profits on that straddle, and what you do is you try to sell a new straddle. Maybe the stock, maybe SPY has drifted up to 521 or drifted down to 521 or up to 523. What you basically do is you recenter that straddle and you sell it again, and you try to collect more premium. And you keep doing that every single time. You either take profits at 25% of max gain, or you just hold it through expiration. That's it. Those are your only two things. So it's actually fairly easy in terms of maintaining. It is a little bit more complicated because you have to take profits on your straddles, and you must close out both legs, both the straddle and the strangle at the end of each day, and reestablish it the next day. You don't want to hold on to the strangle overnight because you do have time decay working against you on the long strangle. You don't want to hold it overnight. So what you basically is close out the strangle overnight, and the next day you establish a new 30-day strangle in addition to selling the at the money straddle.